The MD and CEO Vibha Padalkar. She's joining in right now. Vibha, thanks very much for taking out the time. While Q3 was a relatively strong quarter for you, we are almost at the fag end of Q4, and obviously I'm not going to get into numbers with you now, but just in terms of the overall business and how it's shaped up in the last few months.
It has been a very interesting year, just against the backdrop of a lot of turmoil in the NBFC and largely the BFSI space, as well as macro level volatility. But insurance is a 100-year long-term kind of a product, and we do believe that in building good quality business. So it is not really a quarter-on-quarter journey, as long as our embedded value is of pristine quality, as well as is growing at the consistent rate of about 20%. And in line with that, in your opening comments, what you mentioned on APE growth, that is, I just want to put that into perspective, that is on the individual group, but really one has to see at a total company level, and we have consistently been growing at a total company level. If you look at our 9 months number, we had a growth of 41%, including group business, and on a weighted basis, which is called the weighted APE basis, we grew upwards of 16%. And so that kind of trajectory is something that we will continue to grow and to close the year, while there might be some months wherein we might have seen some tepid growth. Another factor is of the base effect of how we grew last year versus competition, and when you put that all in perspective and when you look at it on a full year basis, we have consistently said that we will grow 2 to 2.5% of GDP on an overall company basis.
Sure. So, while obviously your track record has been good on the new business value, 20% that you clocked in last quarter, is that something that we can probably see happening even in Q4, and probably what would you end the year along the lines of?
So 2-3 data points, we have grown 20% on Indian GAAP. So somewhere in that range of growth in our Indian GAAP profits is something that we have consistently been delivering. Growth in embedded value of similar kind of a trajectory that we have shown in the past. Embedded value operating profits upwards of 20%, as well as new business margins, us being head and shoulders above in terms of being a market leader on new business margins. So again, it's holistic growth as against only one lever, which is top line growth, not necessarily resulting in growth in embedded value. So again, that is something that these 4 metrics that are key metrics to the for long-term growth and sustainable growth is something that we see traction happening, and next year is something that we are well poised on to grow at that kind of a rate.
The analyst community, Vibha, is slightly more cautious with regards to the change in product mix, which is the non-par savings 20% of the new business premium versus 12% in 2018. Now that is a higher capital consumption, which probably wouldn't work too well in terms of the investment thesis that you make for a capital light business model. How would you, respond to that?
2 parts to this. It's actually extremely erroneous view of that non-par savings product is capital heavy and unit linked is not. When you look at the strain that a unit linked business causes because of what has happened in September 2010 of extraction of unit linked charges, unit linked business is equally strenuous in a different manner, because one needs to have enough capital upfront to bear the strain. So it comes out in a wash between these 2 product segments. Second aspect is on the non-par savings product, we are fully hedged. We would not write business unless we are so, and that is reflected in our sensitivity to embedded value. Again, versus peers, we do come out very strong in terms of our embedded value not being as sensitive to interest rate movements, which just shows that the hedging is very robust underlying our savings products. Even if we were to grow at 50% year on year, we will not require more capital. And so I would like to really convince all of you that we would grow cautiously in this segment, and we don't believe that we have exposure in terms of any untoward risks due to interest rates.
So what would the ideal mix be for you? I mean, what is the target for you? Where do you see non-par savings going up to in terms of a contribution to the AP? And unit-linked ULIPs, are you looking to bring that proportion down from the current 59%?
Yes, it should go down to about 50% overall at a company basis when you look at next year. And we are already, if I were to look at the exit rates in February, it is trending much lower than the 59% that you see. It is in the range of about 55%, and no reason to believe again that that southward movement should not happen. So unit linked, while will have a place in the sun, it is certain channels that it augurs better for us to sell unit linked products. We do see non-par savings products, and this includes annuity business as well, continue to trend upwards. Non-par protection, we are the market leaders in that space, that too trending upwards. We ended just short of 15% in the first 17% in the first 9 months in the non-par protection space. That also will continue to grow, and participating will be about a 20% odd range at a total company basis.
So just put into perspective about going forward, are there going to be changes in terms of what are going to be key growth drivers from you, and which segment the growth comes from?
Yes, we do believe in expanding our offerings to the customer, and that's where our primary growth comes from. If you recall, and just a quick recap, we were the market leaders in the pension space back in time. We were the market leaders in introducing children's care segment into India. We moved on online protection space. We then moved on to health space in terms of cancer care, cardiac care being sold through our mobile apps. We then moved on to credit protect space, followed by the current annuity space, and then interest rate guaranteed products. So it has been an entire bouquet of products that we have introduced to India, and we'll continue to do that. And we see growth coming in from this first mover advantage of us innovating, going to the regulator, getting the approval, and then going to market with a value proposition. India is a wholly underpenetrated market. Very clearly, we are lower than what we used to be about 5 years ago. So even if we were to get back to those levels, it would translate to about a 35% YOY growth as a sector. And so, we remain gung-ho. Question is that, are we innovating enough?
All right. Just two questions. This is a side of business. Standard Life recently exited some amount of stake. Do you see more stake being pared? And part two of my question, promoter holding stands at about 80.71%. What is the deadline for you to meet those minimum shareholding norms? And is there a game plan in place?
So that 80% has now come down post the OFS, as you know, which was just shy of 5%. We have, as per SEBI guidelines, any company has 3 years from its date of listing. So we still have another about 18 odd months to get there, and perhaps we will get there faster. We just have about 1% left of the 25% free float, and so that overhang, if you like, that a lot of other companies do have post-listing will go away for us. And a point I want to make here is that as a company, we've always had independent and experienced management team, which has been standing on its own feet separate from promoters. So we don't have a single secondee that has come in from promoters, and that really shows that the fundamentals of the company are a key factor is that it is a professionally run company, independent of promoter groups.